You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, that music means it is time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as from the ever-expanding, ever-exciting Options Insider Radio Network. If you haven't done so already, listeners, I encourage you, check out our latest addition to said network, Options Oddities, a program where we break down all the weird, wild, and woolly options activity that we're seeing out there, all the unusual activity that is catching our eyes over there on the optionsinsider.com. We do that one a little bit differently. We record it every day live on the TD Ameritrade platform there in the TD Ameritrade swim lessons room, actually. So you can even join us live and chime in on the show, have your questions and thoughts answered right there live on the program. It's pretty fun. Check it out. And of course, while you're there, you can find all the other programs on the network, including Volatility Views. You can find them on the website, iTunes, Stitcher, Aha Mobile, wherever you find your finer podcast. And indeed, we've even put them all in one place for you on the mobile app, so you can get that for iOS, Android. And indeed, if you bought one of those 7 or 8 or 1,000 new Amazon tablets yesterday, then you can put it on the Fire OS too. No shortage of ways for you guys to get in touch with us here and listen to the show, stream it, download it, send us your questions, send us your feedback. Really cool stuff. The Options Insider Radio Network mobile app. Check it out. I think you're going to like it. All right, and joining me on the old Vol Views program today, starting off with the man beaming in from the hub, the heart of BGC Partners, the major domo there of financial research, Mr. Jared Woodard. Jared, welcome back to the show, sir.
Hey, Lois, I'm glad to be with you today.
Glad to have you on, beaming in from the heart of sunny and scenic Manhattan there, away from your idyllic life in rural Virginia, but always exciting to have you on the show, sir.
Thank you so much. It's a nice day here. We got nice weather, beautiful skies, and some boats out there in the harbor.
A nice day in Manhattan means the garbage stinks a little bit less that day.
We can't all be Chicago, but we try to do our best.
Gotta dig it in there a little bit every now and then. All right, and that ooh comes from none other than the greasy meatball himself, Mr. Mark Sebastian from OptionPit.com, hot off the heels of our big epic live spectacular for the option block last week. Mark, well done and welcome back to Volatility Views.
Yeah, well, you well done for running up a huge steak bill on me. I was quite impressed.
I do what I must, sir.
Yeah.
When asked to say, will you eat some steak? I'll say sure. Why not?
Yeah, and I thought it was real great that you basically said, is there anything more expensive off this menu that I can order?
Yes.
And they said, sure, this. He said, I'll take that. And so what he ordered was the 100-year dry-aged, bone-in triple ribeye, quadruple thick, with stuffed with lobsters.
Yes, and one to go as well. You forgot about that one.
Yeah, and one to go.
Because you got to bring one home to the wife, otherwise you're in trouble.
Well, exactly. So
good.
No, It was a great time. It was good seeing everybody. We need to do that more often.
We do. We actually got a lot of great feedback on that show, so I mean, we might have to do that more often. It's a lot of logistical work to get everybody in the same place and set up the area, but it's really fun to do that. It's great to meet the people who actually listen to the shows and see people who've been posting on the website for years and actually put faces to some of the handles and things. It's pretty fun. So we need to do that more often. Maybe we'll do a live vol views one of these days. We did it a few years back at FIA. It was really fun. Maybe we'll do something like that again.
Oh, that's a good idea, yeah.
So, Jared, you got any trips to Chicago planned?
You going to come out for risk management as to SIBO RMC, you think, Jared?
Yeah, I'm planning on it.
I am too. So maybe we do it there.
Yeah, maybe we do the vol view show there, right there, in the heart of all things volatility. All right, thank you for that, Mr. Sebastian. And with the team all assembled, we're going to dive right on into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, that funky tune means it's time for the Volatility Review. If you're joining us for the first time, this is indeed the portion of the show where we break down the week that was from a volatility trading and analysis perspective. And we record this show every Friday right around noon or 1 p.m. Central here in Chicago. And, of course, people beaming in from hither and yon. This is Friday, September 19th. For those of you playing the home game, you're listening to it, of course, the following Monday. So, of course, the big story, before we even get into the vol stuff, I just got to touch on it really quick because everyone and their mother was talking about it all day. Of course, we're the day of the big Alibaba IPO. As we're looking at it right now, it's hovering right around the 92 level. So just a smidge off where it opened up today. But other than that, pretty much looking fairly robust, doing a lot of paper, a lot of volume. I'm sure we'll have a lot to say about this one in the weeks and months to come, but not really a vol story. I just thought I would touch on it because this is the only show recording today in the midst of Alibaba furor. But of course, it was an interesting week from a volatility perspective as well. We'll start, as we always do, in the realm of implied, the realm of the VIX cash. And it was a bit of a range for that product. We're trading right now, as we're recording this, listeners, right in the 12.3 range. So right kind of in the middle of its weekly range, had a low of about 11.7 or so and a high right around 14.5 or so. So it's on the lower portion of that range, but well smack dab in the middle there. Perhaps we'll start with you, Mr. Sebastian. What caught your eye this week in the week that was from a volatility, VIX cash, and VIX perspective?
You know, there were a couple things. One, you know, the VIX was really, really overpriced leading into the Fed meeting. Just got absolutely slapped. Then they brought it, kind of oversold it into the Scottish election. You know, I was kind of surprised looking at the SPX opening print this morning. Leading out, the straddle was pricing around $7.50 into around $7.50 into the print this morning, and then the S&P opens up 2022. So the strangle and was just way underpriced. The straddle is underpriced. You know, there's such a penchant to kind of sell this junk that, you know, there's a lot of times that these weeklies can be a little too cheap going into some of those expirations. And, you know, that was kind of what I saw in the last couple of days. You know, here we are today. The VIX is now 12. October is pricing about, you know, $1.90 premium. So things look about as I would expect. I think structure as a whole is pretty good. Maybe November is a little cheap, but that's really all I'm seeing.
Speaking of structure and the range of the products that they're trading in, we, of course, had the settlement this week as well for the old VIX futures. That's been traditionally a contentious part of the month for volatility traders, I think, to put it mildly. We saw recent months settling at some, let's say, dubious areas outside of where the products had been trading right up to leading into that settlement. This week, or this month, I should say, it doesn't seem to be as contentious. They settled this week at 13.03, not too far outside of any real bands or ranges that the products have been trading in, so I don't think it's too contentious. Would you concur with that, Mr. Sebastian? Are you up in arms about the settlement? You think it's pretty much right on?
It was funny that they opened up SPX on the high of the day, but I mean, it just goes to show you there's no way that the market makers had to have been long this expiration. There's no way they got caught shorted. I mean, think about this. Yesterday, in the morning on the open, with the S&P trading 208, you could buy the 210 calls for $2. Are you kidding me? Just ridiculously cheap.
There you go. Upside Palooza over there at the pit. Were you guys just gobbling everything up left, right, and center?
I did buy a call or two and then flip them throughout interday.
Don just turned over in his whatever he's doing. His ears are burning.
His volatility views grave.
His ears are burning right now, saying, "Someone is speaking of buying premium. I must find them." Jared, save us here. What caught your eye this week from a volatility perspective?
Well, we can go into this more if we look around the world, but the big move lower in today in the FTSE 100 volatility side of things. You had the index priced as high as almost 220 in February. So for context, but in this August, September, these spikes around the election and movement there. This is the FTSE 100 vol index got about almost a 16. Today we're down to 10, almost a 10. So huge decline there. Even though the polls weren't, dramatically, more different than I think people had expected, they were roughly in line. And then the VIX flirting with 14, back down to 12. It takes a lot to get the volatility to move, at least in the U.S. market these days, and things are looking pretty quiet.
Yeah, you're talking, of course, about the big no vote in Scotland impacting the FTSE and a lot of other products from a vol perspective. We'll get to that, you're right, a little bit later when we do the big international volatility review, sir. But you're right, it is interesting stuff to see what's been going out there. And you're right, the polls were fairly accurate, surprising. Very, very tight, very, very contentious vote there for Scottish independence. Since we're talking cooking things in VIX and what's cooking out in VIX land, let's get into the VIX options as well. The futures, like we mentioned, settled this week, 13.03. Not a heck of a lot of debate with those. The options are trading fairly robustly, if on the middling end of the ADV range. Like they have spiked well north of 700,000 in the past ADV-wise, and trading right around 530 or so right now. So still volume that most products would kill for, but relatively modest from a VIX perspective. Doing here, I should say, stronger than that today, about 630,000 contracts going into the still a couple hours to go left in the session here today. So it might be a fairly banner day from a vol options perspective today. Looking at what's lighting up the tape since the last time we all got together here, the hot strikes, not surprisingly, the hot activity all pretty much focused in OCC, with the exception of, I think, one Jan and one Nov sneaking in there. And once again, we are 100% calls, listeners. For those of you playing the home game, VIX again, right at the uppermost portion of that call to put range, about 4.4 calls over puts these days, 4.4 to 1. So that's even from historic levels just astronomical for even a call heavy product like this. It's just getting into ridiculous range. Looking at the top hot strikes here, of course, the number ones are the Oct-16s. No surprising, that's right around the at the money there. Followed up by the Oct-17s. Both of those 281,000, 250,000 respectively, coming in right around 250,000 as well. Are the Oct-20s. And then the Oct-18s, we'll talk about those a little bit more in a second. 230,000 contracts roughly open there. Then we move out to Jan. A little bit of Jan love finally coming in. The Jan 20s to the tune of 225,000, so 2.25 there on the Jan 20s. And then looking back to Oct for pretty much the rest of it. Oct-22s, Oct-21s, Oct-19s, and Oct-15s making up the bottom portion of the list from 220 down to 150,000 perspective. And way there at the bottom, doing 143,000 contracts on that strike open, are the Nov 22. So a little bit of Nov love circling in there as well. Overall, we're looking at about a total of 6 million contracts open, about 4.8, almost 4.9 there of calls, and a smidge, 1.1 million of puts. Talking about some of the VIX calls, too, we saw some interesting trades out there this week. In particular, I mentioned the Oct-18s. They were of some note this week. We saw a pretty interesting spread going up out there, and Mark, maybe this one caught your eye as well. It was the Oct-18 21 call spread going up 16,000 times and some change. Paper selling, actually. You might think paper would be coming in, given all the activity we see. Paper gobbling up these things. Paper actually selling it for a whopping 18 cents. So an interesting trade out there. Of course, as with all things VIX, probably tied to something else, OTC, maybe an upside against a long vol position or something else like that. Interesting stuff. This one catch your eye out there as well, Mr. Sebastian?
Yeah, there was a bunch of these trades that, there's another guy that likes to sell straddles and buy upside calls. That's becoming a more popular way of really dealing with the fact that just naked VIX Delta is not a right way to hedge. And so, it's not something it's something that is unsurprising to me, that would be the way to go. Get a little bit of credit, and then if the market blows up, you're actually hedged. And then have the understanding that, if it goes to 18, and it'll probably come back down. And really, you only need to worry about, the VIX, once it breaks into 20, tends to keep going. So it's the way I think smarter paper is starting to use that product as a hedge.
Yeah, a little bit more nuanced, a little bit interesting. It caught our eye just because such a flurry of explosion of upside call buying in VIX all day. To see an actual sell and to do it on a little bit more of a nuanced spreading capacity definitely caught our eye. In addition to the size, it was a fairly, I hate to say light, because light for VIX is a different meaning entirely, but a fairly light week. These kinds of trades usually catch our eyes. Of course, there were some flurries of call buying here or there. One of the, not large compared to what we've seen in the past, but maybe in terms of some upside optimism. We saw some people piling into the tune of 5,000 of the D's 25s as well, gobbling those up for about 65 to 70 cents in that range. So there are still the people out there who are the optimists. They still exist. Lest you think it's all upside call spreaders here in VIX. Looking at some of the other VIX-related products, we like to get into VXST, of course, the product that kind of the famous will they, won't they product. Will they trade it this week? Won't they trade it? Let's see. Let's play the old VXST home game right now, listeners. Let's see how many contracts VXST has traded today on the show. Actually, not a bad day today, doing about 862 contracts so far. I think the last time we did this show, they had done 40 at this point in the show. So a far more robust day today. Looking at what's hot, what's lighting up the tape out there in VXST this past week. Actually, the top spot goes to some puts. That's probably the first time I've ever seen that in any VIX product. In particular, it was the ones on the cycle, the October 1st cycle, so expiring in a couple of weeks there. The 12 puts, 1,000 of those going up. That's pretty much standard open interest, hasn't changed in the last couple of sessions, followed by 800 of the Oct-25 calls. That was also on the same cycle, October 1st. And then we have, dropping off from there, 500 of the SEP 24th, which are the 14 calls, and then there's so many different strikes in VXST. Gets a little hairy, but 500 of the October 15 calls, and then it kind of just drops off from there, hundreds and 80s, not much size left. So yes, VXST doing a little bit more activity than we've seen perhaps in recent sessions, so that's not bad. ADV up to nearly 1,000 again, about 950. Open interest also fairly robust for this product, about 4,000 contracts open. Of that, about 3,500, almost 3,600 of them. Actually, I'm sorry. Let me take that back. Open interest right about 4,000 contracts, and as you might imagine, the vast majority of those falling on the call side. Of course, not as call heavy as VIX Mothership, only about a 2.4 to 1. That's interesting stuff. Mr. Jared, anything else catch your eye out here in either VIX land or VXST or the other suite of VIX-related products?
Well, yeah, I was looking at actually those VXST options today. That 500 lot in it looks like for the September 24 calls was, that could be a reasonable trade if you're looking for a little bit kind of a knock-on action for something next week. Although when VXST was in the 15s not that long ago, and so that put trade, can also be pretty reasonable. I think those are good. These are good demonstrations of why the index can be interesting, because you can get a lot more movement more quickly than in the other longer dated indexes. Otherwise, yeah, I mean, movement in the VIX was kind of as we expected this week in the option side of things, and really the whole way out the curve. It doesn't look like the term structure has really steepened in a remarkable way here. It's not some of the extreme levels in terms of the spread between near-term and medium-term futures that we've seen over the last several years. So right now the curve looks actually fairly reasonable to me, and with a lack of big risk scenarios on the horizon, maybe even a little bit expensive from a historical point of view.
And listeners, he's referring to a trade that went up today. It was the SEP 16s expiring in 5 days, so a near-term trade, obviously, like everything else in VXST, going up 500 times on open interest of just 24 contracts. Looks like paper was buying. I'll have to dig into that a little bit and see exactly where they went up, but I believe paper was buying on those. We'll dig into those a little bit, but interesting stuff, seeing some decent trades going up here in VXST. So apparently this is a will they week for VXST and not a won't they week. We'll see if this momentum, such as it is, can keep going into next week. Meanwhile, we'll move on to some of the other products you guys love it when we talk about here on the old program. The other products that have volatility. Surprise, surprise, there's volatility in a whole range of products, not just things that have VIX on them. And you guys like to look at the shiny stuff, indeed the precious metals. Looking at gold, this is something we were talking about on our Futures Options Roundtable show this past week as well. That's interesting stuff cooking in gold. We've talked about gold from an implied vol perspective in the past, of course, having that big pop along with oil after the big ISIS and potential threats to that region and threats to supply. We've seen that come off as indeed supply has remained strong, as indeed as global demand has kind of tapered off. For a lot of these products, it's kind of been a 1-2 punch for these products. They come off, and they've also come off from a vol perspective as well. So we're seeing a little bit of that today. We're pulling up before the show some interesting stuff here in the gold futures options, looking at what Skew is cooking up to out there across a variety of expiration months. And listeners, you can't see this, so you'll have to just take our word for it, but I encourage you to dig in some of these charts if you can. It's interesting to see. Usually you see a lot of these products, you see some sort of flatter skew or that type of smile type skew that you'll see in a lot of typical commodity type products. And here we're seeing a very pronounced put skew in gold, clearly indicating that people are still worrying and positioning towards a lot of perhaps downside movement. Clearly that's most reflective in some of the nearer term contracts, but even the longer term contracts are starting to show a pronounced bid, some pronounced vol levels going into those put wings. You know, most of the at the money vols hovering in the 12 to 13, maybe 14 range or so, but some of those put wings getting noticeably higher, well up into the higher teens, and even on the tail end of some of those put wings flirting with the 20 handle. And so interesting stuff. Jared, does this surprise you? They're seeing a lot of perhaps downside interest out here in the metals right now, in particular gold. We'll get to silver in a second, because these are products, like I said, usually have a little bit different skew, but clearly people have some concerns to the downside right now out here in gold.
You're right, and that skew is pretty pronounced, pretty interesting. If you compare where GLD option premiums were even 2 weeks ago, certainly 1 month ago, you see a pretty significant shift across the curve. You know, not as much in the upside strikes, even in at the money levels, but like in a 90% moneyness put option, they were priced 2 weeks ago at about 20%. A little bit lower than that about a month ago. Today, those, that same, like if you try to buy a put that's 10% of the money, you're going to pay more like 23 or 24% implied vol. So it's a pretty significant move higher at that level. And so it does reflect, I think, some sentiment for more downside potential in the metal.
And the funny thing is, if you go over to its sister product there, silver, which some people will debate whether they trade differently, because they are indeed very different products, but still a lot of people lump silver and gold together when they're doing a lot of their talking about the metals. And looking at the silver skew now, and it is very much a different story. It is much more of the traditional smile-oriented skew that we're familiar with in a lot of products. So some bid to the call, some bid to the puts. Clearly, silver right where it's trading right now, right around the 18 to 19 handle range. Clearly, it's a pick'em market. People are betting to the upside and to the downside that this thing could move. So that's probably what we expect more in a more normal type environment. So the gold skew coming even more pronounced as a result of that. It's certainly something that bears watching here in future episodes. Mark, I know you guys over there at the pit like to focus mostly on the ETF side, so GLD and SLV. Jared hit a little bit on GLD. Have you been noticing anything of this as well out there in like GLD and SLV land, something that maybe would attract you guys into some of the downside trades out there?
Is having a real rough go of it. There's, a lot of people don't think interest rates are going to be going lower anytime soon. The dollar's getting stronger, not weaker. I mean, there's a lot of reasons to, potentially like a second leg lower in gold. Precious metal vol tends to explode when it starts to move. So, I'm unsurprised that, we're seeing volatility move like this as gold. Looks like it's getting set for a second leg down in this bear market it's been going through.
Yeah, we're seeing some similar developments out there in the energy realm. Like I mentioned, gold and the energy is kind of moving a little bit in lockstep of late, both from an underlying perspective and from a vol perspective. Oil perhaps taking a little bit more on the chin of late than gold has. But now looking out here in the futures options out there, in particular some of the Brent products, again, we're seeing some pronounced skew, not perhaps as flat to the upside as gold, but some definite pronounced put skew here in the Brent options as well. So interesting to see. People are definitely prepping, even though a lot of those energy products are trading very near their lows for recent sessions. Still, a lot of people still loading up on what we're seeing out here to the downside. Jared, I know you watch a lot of the energy products as well from a vol and a skew perspective. Does this surprise you at all, or is this pretty much as you expected out here?
Not too much is surprising, although I would note that if you want to make a comparison in terms of where skew in crude oil has been and where it is now, the put wing, the put side of things has been roughly kind of moving in lockstep over the last 2 to 4 weeks. But you have seen a big move lower actually on the call side of things. So looking at like any out of the money puts really, say 1 month ago, you had some significant upside call skew like we would normally expect to see really. Lately, I'm looking at the curve today and especially when you get up into the higher strikes, you're just seeing much lower implied vols at that level. So, we would normally interpret that to mean people expect less potential for upside in terms of really big moves higher. And I think that's consistent with the kind of slowing demand around the world that's driving some of these international equity indexes to be priced more expensively in options terms, and concern that growth might slow down, even potential for less fantastic growth in the U.S. in the next quarter. You can see a picture that is made worse by the ongoing kind of supply glut in oil as the U.S. just keeps moving to new production highs.
And of course, there are other areas we cast our volatility glance to, including beyond the domestic shores here of the U.S. Jared alluded to at the top of the show what's cooking out there in Scotland and other areas, and we'll certainly get to that. But there are many regions and many products to talk about when we get into the international volatility realm. And I know, Mark, you guys over there at the pit like to watch a lot of these products as well, including a lot of the emerging markets and South American volatility products. What's catching your eye out there from an international volatility perspective?
The big thing is we're always trying to find something to sell if we want to buy something, or something to buy when we want to sell something. And if you're looking to sell something, take a look at VX EWZ or just EWZ and EM vol. They're kind of through the roof right now into these. There's elections over there, but they're pricing in a really big move into EWZ, and with that, EM is seen its volatility not in the toilet the same way the S&P 500 is. So, that's something to really remember and think about. So, that's the way I kind of view, in general, kind of how the market is that they've kind of, I think, overbid up some of the EWZ and some of the internationals. And so if you're looking to sell something, there might be that kind of established market, emerging market, vol swap trade kind of developing.
It's an interesting dynamic that's playing out now. You've got some speculation about whether capital flows to emerging markets are going to start to trail off or be affected as investors, as March basically of next year, May of next year come closer and people start thinking about changes to Fed language and changing rate environment. Eventually, those kind of concerns are going to come to fruition, and it's I guess a question right now about whether people are going to anticipate next spring, how soon they're going to start anticipating next spring in terms of where they're looking and where they're allocating. And like I mentioned before, when you've got concerns about growth slowing in emerging markets, when you've got concerns about whether China's going to be able to keep a glide path for gradually slawer growth rather than something much worse, it makes sense that we'd see some more reactivity in the vol side of things in these markets around the world.
All right, that's going to do it for our volatility review, listeners. And now we're going to keep on rolling right on into our volatility voicemail segment.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the Volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, welcome to the Volatility voicemail. This is indeed the portion of the show where you guys get your chance to join us here on the old Volatility Views panel. Make your questions, your comments, your insights known not only to us, but to your fellow Volatility Views listeners. This first one's an interesting one, Jared. I'll be curious to get your opinion on this. It seems to be the big dichotomy, the big debate, the big discussion amongst people deep in the industry, but I think for a lot of our listeners too, it's interesting to them. Interesting, one more time. I think for a lot of our listeners too, though, it's certainly interesting to them. In fact, one of them wrote in with this very question, so we'll start there. His question comes from John King, listens to a lot of our programs here on the network, and he writes, could you do a show with an in-depth discussion on LiveVol versus IVolatility, cost benefits over standard broker data, etc.? Thanks. That's an interesting question, and I mentioned this because, like I said, a lot of people in the business are having this discussion on a regular basis. Which platform do they want to use? Which data they want to use? Which tools, et cetera, et cetera. I know a lot of the market-making community likes to use the LiveVol platform, and so it's interesting question. I tend to think of these two tools kind of in a little bit different framework, and I'll be curious to see if you agree or if you think of them differently, Jared, because I personally use both, but right now I'm using a lot of LiveVol right now as we're doing the show, because I think of LiveVol as more of a real-time kind of analytics platform where I use it in conjunction with my trading, with my analysis when I'm doing shows, when I want to break down open interest, ADV, what's trading right now, the stats on a particular name. I go directly to LiveVol because they have all that there readily accessible. It's a much more kind of trading-friendly type interface. It was designed by market makers. It's used by a lot of guys on the desks and in the prop shops still here in Chicago on the market-making desk. And it use it for a lot of that kind of stuff, very quick type analysis. Not to say you can't do deeper dives. There are tools in here. They have their scanners and things. We talked recently, a listener wrote in suggesting their straddle tool. So they do have some cool scanners. You can go in here and scan by, price scanners, implied volatility changes, implied vol versus historical vol, order flow, all kinds of different things. You can look at different sectors. You can look at skews. You can go deeper into the platform. And what I'm talking about here, I should clarify, is the LiveVol Pro platform, listeners. I believe this is, $200 a month. We can get into the cost breakdown a little bit later. They, of course, have other offerings. They have more professional offerings for if you want to get into data analysis. You can do that with some of their data stuff. And, of course, they have the LiveVol X brokerage platform. So if you're a brokerage client of theirs, you can access a lot of this stuff as well. So that kind of muddies the waters a little bit because they have a lot of different offerings. And the same thing, quite frankly, with IVolatility. It's not really a direct one-to-one comparison with these two because they also have a myriad of different offerings. But I tend to think of iVol as more as when I'm have some time and I want to do some research on a particular underlying or a particular trade or a sector or whatever the case may be. They have a lot of great scanners and tools and things that do a lot of volatility analysis over there, hence their name, iVolatility. So the way my use case is, I use it iVol for more of the real time, what's going on right now. I'm trading this, I'm looking at this, I'm analyzing this, what's happening out there right now. And you can do some surface analysis there too. And for a deeper dive into that kind of thing, and if I have a little bit more time to play around with it and tweak settings and things, then I will go over there to iVol. That's kind of my quick breakdown of those two platforms. Do you have a similar use case, Jared, or do you disagree entirely? You're going to pull a counterpoint on me, a crossfire, if you will.
My take is that those platforms do have some interesting differences. I think that the offerings from iVolatility are spread across a few different tools rather than in one central piece of software. And if you know exactly what you want and you're, I think, really cost conscious, it may be that some of those a la carte offerings from iVolatility might be suitable. They do have, I think, iVolatility and LiveVol both specialize in offering some data for download and that you can buy, which is something that I've used in the past. And I was really satisfied with both when I've looked at what they had to offer. And in terms of tools and analysis, LiveVol does have some really interesting features that haven't been made available, at least not easily available before, to individual investors. And so I'm a fan of both. If I had to choose one, I'd be hard pressed. I think that the surface and skew and other volatility data is going to be roughly comparable across the two providers in terms of data quality. And I think maybe LiveVol has a few more bells and whistles, but ultimately, implied vol data is implied vol, and it matters not so much where you get it, but what you do with it once you have it.
Yeah, you're right. There are so many a la carte offerings. It's kind of hard to directly compare them because someone could come to iVol for one completely different use case than someone goes to LiveVol for, or vice versa. It really is not the completely same comparison, but there are, of course, a lot of similarities in the two. LiveVol, I think, has a little bit more UI tweaks and is a little bit more user-friendly on that side. Of course, you pay for that. It is, like I said, I believe $200 a month for the LiveVol Pro and different pricing for some of the other things that they trade within there. If you become a LiveVol X client, that might become more of a better deal for you on that side. You mentioned the cost analysis too here, John, and that's an interesting question as well. Of course, standard broker data is always going to win the cost battle because it's free. And what you're getting, I don't know, you don't mention who your broker is here, but the things you get for free from TD Ameritrade and from Options Express Schwab and a lot of the other big options brokers, the options houses, the Trade Kings, et cetera, they're fairly robust, those platforms now. So if you want to come in and if you're doing, a handful of trades a month and you're just looking at, some volatility levels here or there, maybe you like a particular strategy like an iron condor or something like that, and you want to look where to get in and where to get out, maybe do some basic underlying analysis and things like that. I think the standard brokerage platform is going to do you pretty much all you need to do. I mean, it's kind of dismissive to say, the standard brokerage platform, because they do spend many millions of dollars on those platforms to give you a lot of cool tools essentially for free. So I wouldn't dismiss those. I would definitely, if you think about paying for these, I would first dig in very deep into your brokerage platform. Make sure you're familiar with, because all these things are buried. They don't promote it very well. It's kind of the problem. But they might have some cool things there you're not even aware of that you could do scanners for. Like, of course, a lot of people like the Idea Hub over there on OX, and Thinkorswim has their spread book and things like that people really like. So play around with those and really kind of get a feel for that and see if maybe that's enough for you and you're getting it for free, which is the best price of all. If that's not, then maybe you want to upgrade to some of these more a la carte or individual type services. Then it's really pretty much a trade-off of how much you're trading and is it worth it for you to spend a couple $100 a month on a different software platform or a certain thing like that. If you're trading fairly actively, a couple $100 a month is pretty nominal. I would suggest you'd have access to at least one of these going on a regular basis. And you can, on certain things on iVol, you can get some free services as well. So you can do it on relatively low cost over there on iVol. It really depends, and the names are so confusing too, LiveVol, iVol. But it really depends what you're using them for and how actively you're trading. I'm guessing if you listen to a show like this and writing in, you're probably a fairly active spectrum. So I would say it's worth it to buy one of these platforms or buy tools or access to one of these platforms. Again, it's really hard to recommend one without knowing exactly what you're trading, what products and what types of trades you're doing. But in general, I would say one of them is worth it if you're trading fairly actively. And if you're listening to a show like this, you probably are. But don't discount the standard broker data. Again, I hope that helped you there, John. Like I said, it wasn't the most specific, but then again, it's hard to get specific without knowing exactly what you're trading. But both platforms, very robust, very good. Both have a lot of offerings, and both are going to cost you, at least a few $100 a month, if not more. So if you're comfortable with that level and you're trading enough, you have multiple screens set up, you have your broker on one, you have your LiveVol or iVol on the other, then you have a pretty good setup, and you're actually fairly equivalent to what a lot of prop shops are using out there. I'll go to a ton of these shops, and you'll see guys out there with their standard proprietary system, whatever, on one screen, and next to it they'll have a LiveVol or an iVol running just like you. So you wouldn't be that far away from what the quote-unquote pros are using out there if you're using one of these. All right, next up, we have a question from listener Indy04. He writes, might be a strange question, but does implied volatility always exist? Are there options out there that essentially trade at their realized volatility level or some other type of, I think you meant of here, of riskless rate? Keep on rolling with the show. I love it. Big fan of the network. This is an interesting kind of existential question, Jared. So I'll toss it to you first because I know you are a diehard philosopher at the end of the day. So I'm sure this question appeals to you on a fundamental level.
You could say that, okay, I mean, we could say, if we wanted to, that implied volatility never exists until a trade prints. I mean, if I quote you an at-the-money SPX option at a penny and $100, really crazy wide market, the implied vol that you would get from those price quotes would be really crazy too, right? So in that sense, those implied vols would exist in some NBBO trail somewhere, but just they wouldn't really exist because they didn't trade at that level. So I guess if we assume that he means sort of is implied vol, it sounds like the question really comes down to, are there assets where the implied vol in the options that trade is roughly close to realized vol a lot of the time? And absolutely there are. I mean, there's lots of stocks that don't trade at a hefty premium, whose options, I should say, don't trade at a hefty premium to realized volatility. And you could probably guess which ones they are. I mean, they're the quieter, less dramatic stocks who act with more certainty, and you could probably think of stocks that behave in the opposite fashion too. Biotech stocks and really high beta tech stocks will often have options trading well above realized vol most of the time. And so, it depends a lot on what the nature of the price distribution of the underlying is. That doesn't mean that implied volatility doesn't exist, though. I mean, if we're going to be, careful about terminology, an option whose price, moves roughly in line with the realized volatility of the stock and doesn't get priced at a meaningful premium, still has an implied vol, right? It's just that implied vol tends to be similar to the realized vol. So does that mean there's any edge there? I don't think so. But it's just a matter of, again, what the distribution of the underlying is like and how volatile the underlying stock is like and how much uncertainty about the future there is for the underlying asset.
Yeah, it seems like there's a lot of different ways you can really look at this question. I think from a pure 10,000-foot perspective, pretty much in any product you want to trade, the answer is yes. There's going to be some sort of implied volatility structure. If there's options on it and they're trading for any length of time, there's got to be some degree of implied volatility. But if he's talking, that's more on the theoretical side. If he's talking more on the pure practical, are there opportunities when realized and implied maybe diverge, and that gives trading opportunities? Yes, we talk about that, like you said, Jared, all the time on this show. That's something we look for a lot at the Options Insider and on shows like this. Hey, here's a time when realized spiked up over implied. That's odd. Maybe you should take advantage of that. Things like that happen on a regular basis. They're fleeting. They don't last for a very long time, so it's hard to say that these are systemic things. I can't think of off the top of my head a name that trades beyond realized, beyond implied every time. That would kind of defeat the purpose of having an implied. And I would say the market makers would be doing a pretty poor job out there. There also are some weird esoteric scenarios where, let's say, maybe you have a deep in the money European style option where it's all kinds of screwy when it gets down to intrinsic value versus extrinsic value. And there's some of those scenarios out there that we could talk about as well. But those are few and far between. And it sounds like, for the bulk of his question here, what he's referring to, it does exist for pretty much anything you're going to want to trade on a regular basis. And if those scenarios do where they invert and things like that, then we'll talk about it here on this show. And that's a great time for you guys to dive in and start trading these products because it creates an opportunity. But for 99.9% of the things you're going to look at and trade on a regular basis here, Mr. or Mrs. Indy 04, definitely there will be some sort of implied vol structure out there. Whether it's very, very much higher than realized or not, that depends on the product, like Jared said, but it will at least exist. And that's pretty much the core of your question. Interesting one. We get some weird, I shouldn't say weird, that's dismissive, but we get some good questions here from our listeners, Jared. They dive deep into some interesting and somewhat esoteric aspects of volatility, which I like. And I know you, the deep philosopher that you are, love these kind of questions as well.
I won't claim to be deep, but I do enjoy thinking about these funnier sorts of things. Let me add to one practical point to that, though, which I think is implicit in what you just said, which is that given that there tends to be, let's say, a 2 or 3 or 4 percentage point spread between the implied vol and like at the money front month options on a stock and the stock's 1 month implied or realized vol, given that there is usually a bit of a spread there, I think it's worth thinking about why that exists and whether that's something that you could be arbitraged away or not. Most of the time, I think it's not. And the reason that it exists is because You have liquidity providers who need to be compensated for the work that they're doing and aren't going to sell premium all the way down to no spread at all. And also because if you back out in price terms, what a half a percentage point or percentage point change in implied vol might be for a given option, sometimes it's not a meaningful difference in the actual price of the option contract, depending on how wide the bid and the offer are. So I think that always comes back to what you can actually execute in the market is really important when we're talking about analyzing implied volatility. Otherwise, it is all kind of can remain at the level of the theoretical or the interpolated. And unless you can actually trade it at a price that is attractive, the rest of it is just kind of academic.
Yeah, that's the big dichotomy for this question. There's a lot of theoretical rabbit holes you can go down and comparing implied and when it exists, when it doesn't. But yeah, the practical tradable opportunities for those are very, very few and far between. So yeah, like I said, for 99.9% of the things you're going to be concerned about there, Mr. or Mrs. Indy 04, just consider that applied vol does exist. Maybe you don't like that, maybe you do, I don't know. But either way, that's the world we live in. All right, and that's going to do it for the volatility voicemail. Now we're going to keep on rolling right on into our final segment. It's time to open up the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, listeners, you know the drill. This is the portion of the show where we go deep into the weeds and prognosticate and estimate recklessly and clearly without any sort of responsibility whatsoever what's going to come down the pike from a volatility perspective. And when we're talking reckless prognostication, none other than Mr. Mark Sebastian is the guy you want to go to. Mark, where are you falling on the week to come from a vol perspective?
A seller of vol. I'm a seller of VIX. I think anything above 12 is too high. I actually think anything above 11 is too high. That being said, if they come in and just absolutely blast the straddle on Monday, those weeklies have been getting a little oversold early in the week. So that's going to be something I'm watching. But I think it's going to be continued rough waters for gold. And again, that Brazil vol is too high. So one trade I might look at if things get really, really cheap is kind of a Russell 2000 Brazil SPX kind of trade somewhere in there, because the Russell's is the one U.S. index that actually has been moving. So, I'll be looking around somewhere in there.
Yes, and we've seen a lot of that of late. The weekly is getting a little bit, let's say, hammered going into that portion of the week. So maybe, dare I say it, there might be some buying opportunities in those early portions of the week, or at least you get a free weekend or so out of it. Not the worst thing I could think of.
Don's not happy. You better not say that.
No, he's not happy at all. Well, you're talking about buying all sorts of crazy stuff, so I figured I could at least throw in one buying mention there. All right, Mr. Jared, what is your wild prognostication from a volatility perspective, sir?
I have to say first that I think when you started introducing this segment in terms of prognostication, that was pretty tame. And then as the weeks go on, it seems to get more and more strident until I'm afraid in December you're going to have us, painted as like insane desert, prophets or something.
Trying to draw the eyes of all compliance everywhere, sir.
Yeah, absolutely. We've talked about this, I think, before this year several times, that the pain trade this year, the most uncomfortable thing to do has been to sell volatility at nominally low levels. People were really screaming about this in the spring of this year, talking about VIX complacency, and you know what? It just never materialized as a matter of actual complacency, because there wasn't any market risk that wasn't being adequately hedged. And instead, sellers of premium who can hold their nose and do the thing that they maybe don't want to do have been rewarded pretty well. We talked about VIX straddles at the top of the show, and that's one of the strategies that we've been talking about with clients this year with some focus, because selling those VIX straddles and hedging with some tactical criteria has worked really well, and it works really well in spite of the nominal low level of VIX, and I think that's likely to continue into the end of the year.
I'm sure clients turn their noses up at you at first when you come to them and say, by the way, you should start blasting out some VIX straddles here, because all they've heard from the general media is how cheap is VIX, how cheap is VIX. They must think you're a mad person. So I'm sure those initial conversations must be pretty fun. I would like to be there, a little fly on the wall for those.
I think that it's the one contrarian trade that's left. Being a bear and paying up for dramatically expensive hedges was, I think, a popular contrarian orientation a few years ago. But now, I think that being able to sell vol when everyone, even bullish investors, don't want to do that, I think is the last good contrarian position to take.
Interesting. I like it. I'm not disagreeing with you. I definitely agree. I think it's an interesting trade. I like to see you guys pushing it out there to clients. That's good. Getting them away from the conventional wisdom. And certainly we've referenced Don many times on the show. Certainly he's happy to hear that you're talking about blasting out some straddles. Good stuff, sir, as always. All right, that's going to do it for the Crystal Ball segment. It's also going to do it for this episode of Volatility Views. But before we go, really quickly, let me check in with each of my cohorts here, my partners in crime, see what they have coming up that may interest you. Starting with you, Mr. Sebastian, what's coming up in the land of the pit?
We've got a event, introduction to VIX and VIX ETPs on the 24th. That's Wednesday. Go to optionpit.com/events, and that is a lead-in into our VIX and VIX ETP primer, which is Saturday, October 4th, just $47 and free for Option Pit subscribers. So check it out if you have a moment.
All right, thank you for that, Mark. And Mr. Jared, what's coming down the pike aside from all of your studies you're doing for us, as well as all of your straddle blasting out there at BGC Partners?
I'm working on a new technical and a systematic strategy actually right now that should be ready in a week or two or three. And we're also doing a look at what residual risks there are for the fourth quarter. I like to do a quarterly review of potential risks in the market and how to price them and hedge them. And as well as we got off a really nice couple pieces ahead of the Alibaba and Yahoo brouhaha this week. We were looking at some short straddles in Yahoo, short strangles, I should say, that on this first day of trading of Alibaba anyway, seemed to have worked out fantastically well. And I think that was an event-driven story that was really interesting to follow. Hoping to do some more of those in the remainder of the year.
Yeah, everyone and their mother was talking up buying Yahoo Premium. I think Barron's and others were talking about buying verticals out there in the November expiration cycle and things like that. So there were certainly opportunities if you were amongst the folks who perhaps disagreed or want to take the contrarian view and wanted to sell some of that skew, some of that premium in the wings, then certainly the media was helping bid that up for you. So it made it fairly attractive. I could certainly see why you would be tempted to the dark side on those trades, sir.
Yeah, you cannot resist that kind of massive upside Yahoo skew, even if you're bullish on the stock.
Yes.
It's just one of those things that doesn't come around all that often.
All right. Thank you for that, Jared. And on behalf of Jared and Mark, and of course myself, I want to thank all of you for downloading and streaming and for subscribing to the show, and of course for sending us those great questions. Keep those coming. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.